This video is going to detail a kind of short-term breakout strategy involving two opposing positions, each with a tight stop loss. We'll run through some worked examples to show how this might work. Do keep watching to the end of the video because we're going to talk about a risk that is inherent to the strategy and look at ways in which you might mitigate that risk. Hello, I'm Peter Martin with Trading 212. We add educational videos about trading to YouTube regularly. If you haven't already, make sure you subscribe to our YouTube channel so that you get to know whenever we add a new video. Well, let's get into the details of this strategy. You might have noticed that there are certain economic releases, economic news events that have a tendency to move the market. For example, the monthly employment situation report for the US or Fed announcements following FOMC meetings. This strategy attempts to profit from such movements. What's nice about the strategy is that it doesn't rely on the market moving in any particular direction. So the general idea is, let's say that these are some fairly short-term price swings that we've been seeing in the market, and we're heading into some news release where we think it might spark the market into movement, but we're not sure which direction. So we go long and short the market with fairly tight stops. We have stop 1 here, which is for our short position above the market where we're selling, and then stop 2 here, which is below the market for our long position. And the idea is if the market breaks upwards, then it takes out stop 1, but our long position for stop 2 keeps on making us money beyond that. Or if the market pushes lower, then it will take out stop 2, which is on our long position, but our short position here would keep on making us profit beyond where the stop is. So basically, with this strategy, when you're heading into the economic event of your choice that you think might move the market, you're placing two positions, one long, one short. Each has got a pretty tight stop loss. And the idea is when the market moves, whichever direction it might be, it's going to take out the position that is the wrong way round, the losing position, and the position that is profitable is going to be left open. Now, if you're attempting this strategy, one idea might be to look at different time frames of the instrument of your choice, just to try and get a feel for the different price moves that the market is capable of making. So let's take a look at this. So I'm looking at a euro-dollar chart. I'm starting here with a daily chart, and a lot of these price swings that we're seeing here have been of similar-ish magnitude. If we look at this one, it goes from about 114 down to about 112, so roughly speaking about 200 pips. Similarly, if we look here, we go from about 114.20, let's say, down to about 111.75. So that's about 245 pips. But we're talking similar-ish kind of levels in a very broad sense. A couple of hundred pips, 250 pips, that sort of magnitude. Now, if we switch to a 4-hour chart, we can see that the swings on the right-hand side of this chart, these shorter-term swings, are much smaller. These are more like 80 pips. We're going here from about 112.80 down to about 112. And if we go to our hourly chart, then we're seeing the same sort of thing. These are the same swings that we're seeing, about 80 pips. So just as a kind of common sense check, if I'm looking to profit from one of these intraday price swings, then that tells me something about how close or far a sensible stop distance might be. Now, if I'm hoping to make 80 pips profit from the winning trade, then I need my losing trade to be cut out significantly closer than that. Maybe, let's say, 30 or 40 pips. You might decide on something else, but at least we know from a common sense perspective, given the size of the swings we're looking to try and profit from, then those kind of distances don't seem conspicuously unfit for my aims in the same way that, say, a 400-point stop might be. Now, a 400-point stop might be just fine for someone else trading with different goals, looking to trade over different time frames. But for the purposes of this strategy, trying to profit from intraday swings sparked by the short-term effect of a news release, and for this strategy, we're looking for something congruous with the intraday price swings that the market has been exhibiting. So for my example, I'm just going to go long and short and place quite tight stops, 40 pips away from the opening level. So let's open a detailed trade box, going to put in 5,000 as my deal size. It doesn't really matter, it's just to give you an idea of what I'm talking about. And then the stop distance 0.0040, that's my 40 pips. Confirm buy. Now if I just open another detailed trade box and sell and put my stop once again 0.0040, and I want the same deal size, 5,000, confirm sell. Now if we look at my open positions, then here are my two euro-dollar positions, long and short, and I have stops 40 pips away from my opening levels on each. What I'd like to do is to work through some real world numbers. So let's take a look at an example of using this strategy to trade the US 30 index at the release of the non-farm payrolls report at the beginning of July 2019. So for our example, we are looking at the 5th of July, which is when we had the employment situation report for June. The report comes out at 1:30 p.m. UK time, and this is an hourly chart of the US 30 index zoomed in for that period. So if we look at this candle here, which is the 1 p.m. candle, our tooltip shows us the open was 26,923. So let's use that as the basis of our example, opening our trades when the market was at around that level. So let's look at the numbers for how our opening trades might be set up. So for our US 30 example, the quote, we said the index was around about 26,923 with a 3-point spread. The bid offer might have looked like this. So our quote, our sell price 26,922, the buy price 26,925. And we're going to be trading on both, of course. So our first trade is going long, buying $5 a point, let's say, as our size. We'll do the same size for the short and the long position. Buying $5 per point at the offer, the higher price, 26,925. They'll put a fairly tight stop. So let's put a stop 50 points away, 50 points lower. So this will close our position if the index drops to 26,875. And then we'll take a profit with a limit order. So our take profit level, 110 points higher, 27,035. So this is a nice favorable profit to loss ratio here. 110 as our take profit level with a 50-point stop loss. And for our second trade, trade 2, we'll be selling $5 a point, so the same size as we did for the buy, but we'll be dealing at the bid here, the lower of the two prices in the bid offer quote. So we're selling 5 at 26,922. Just as before, we're going to put a 50-point stop loss on it, so stop goes above. The index rises to 26,972. This position will get stopped out, and then we're taking profit if it drops 110 points. So our limit order, our take profit order, 110 points lower, which is 26,812. When the non-farm payrolls came out on the 5th of July, they were much stronger than expected, albeit with a small downward revision to the May payroll growth. But overall, it should have been a bullish result as far as the US stock market goes, all things being equal, but we often have more things in play at once. The situation was complicated somewhat by the market hoping for a rate cut, and this report was strong enough to derail those hopes. And the short-term reaction was actually negative for the Dow, so we can see how it sold off after the news was released. The useful thing about our strategy is it doesn't rely on the market moving in any particular direction. All it relies on is just that the market does move consistently in one direction. And we can see that is actually what happened. So as we said, we're up here at the open. When we opened our positions was around about 26,923. The market sold off. And it got down as far, if we look at the low of this candle, this was just a couple of hours later, it got as low as 26,726, easily enough to fill our limit order on our short position, and we would have been stopped out a lot earlier with our our close stop on our long position. So let's look at how those numbers would pan out. So the way things worked out for our US 30 example, our first trade, trade 1, we were long $5 at 26,925, and the index dropped down to our stop level. So we got stopped out at 26,875. So that's 50 points away at $5 per point, means that our loss on trade 1 is $250. Now trade 2 is where we went short $5 at 26,922. and we had a take profit 110 points lower at 26,812. So the market dropped below that, and so we would have taken our profit at that level. So our profit was 110 points times $5 per point, $550 profit on trade 2, and then overall it's $550 minus $250, meaning that overall we made a profit of $300. Let's now summarize the main features of this strategy and one key assumption that the strategy relies on. So the doubles tight stop strategy is a short-term play. It's not intended for the medium term, it's not intended for the long term, and the reason for this is that we are really just focusing on the immediate aftermath of the release of economic news. So the strategy counts on economic news sparking a move in one direction. So the idea being that you're heading into major economic news. You've noticed that there's a tendency in the past for that news to move the market. You don't know which direction it's going to move. You're not counting on it moving in any particular direction, but you are counting on it moving in one direction. And the idea being that with 2 stops either side, constraining your losses, whichever direction it does move, the position that is the losing position, the losses will be constrained. The position that's the winning position will not have its profits constrained. One assumption is that it assumes that your stops will get filled at the stop level. So that is a risk if that doesn't occur. So let's talk a little bit about gapping markets. A gapping market is where we get one period closing at a certain level. So if we look at this green candle, we can see that the market has closed for that period here, and then the next period has opened away from it. So here the market has gapped. Now let's say that you were long the market and you had a stop loss that was here. Then your stop isn't going to get filled at that level because the market, rather than trading through your stop, has gapped through it. And the best available level to fill your order is here. Now, when might this happen? Well, it can happen between trading sessions, overnight or over the weekend. Also, though, it can happen in market trading hours when we have exceptionally volatile or illiquid market conditions. Now, this may not be that common, but it is something you need to be aware of. So let's have a look at what we can do to try and make things a little more favorable for us in terms of this. So these are favorable conditions in the sense of trying to help ourselves in terms of that assumption that our stops are going to get filled at our stop level. It doesn't mean that if we trade FX that we're going to succeed with this strategy, but if we trade FX, which is very liquid, and it increases our chances of stops being filled at our stop level. Similarly for popular stock indices, they are liquid. Things like the S&P 500, the Dow Jones, the FTSE, all liquid stock indices, as opposed to, let's say, lower cap stocks that may be illiquid. So any kind of time where we sense that the market is illiquid, it's probably not a good time to be trying to use this strategy. Obviously, inherent to this strategy, trading over economic news, things are going to be volatile, so there is that risk inherent with it. As we said, the strategy is intended to be intraday anyway, but that does avoid holding over multiple sessions where more often than not, when you're going to see a market gapping, it's more likely to be overnight than during market hours. Now, I don't want to scare you with the thought of stops not being filled at their stop levels. In normal market conditions with liquid markets, stops should be filled at the stop levels with trading 212, but you need to be aware that it is subject to market conditions. In certain extreme market conditions, stops may be filled away from their stop level. If markets gap, then they won't be filled at the stop levels. If you want to try this strategy out, it's always worth giving it a go in practice mode, first of all, to see how it goes. And there you can get a feel and quantify how often markets gap. Well, I hope you enjoyed this look at this strategy. If you did, please hit the thumbs up button and give us a like. Or why not let us know what you think about the strategy by sending us a message in the comments section. We do read each one. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.